Hey folks, welcome to another video by Stock Trades. My name is Matt, and today we are going to be looking at renewable energy companies. Now, we understand this might be a controversial subject for certain parts of the country. However, there is no denying that there is a clear shift to renewable energy. Yes, fossil fuels aren't going anywhere anytime soon, but investors will want to ensure that they have exposure to renewable energy in their portfolios. And we'll give investors ideas right after this. Before we jump into our stock selections, let's take a look and define renewable energy itself. According to the Natural Resources of Canada, renewable energy is energy from natural resources that can be naturally replenished within a human lifespan. So renewable energy companies provide sources of power that are considered cleaner and more sustainable than fossil fuels. Some examples of renewable power include hydroelectric, wind, solar, biomass, and hydrogen. At the moment, renewable energy provides nearly 20% of Canada's energy supply, with hydroelectricity accounting for over half of that. One common misconception: renewable companies aren't new. In fact, they have been around for quite some time now. As a result, many clean energy stocks provide stable and reliable cash flows, much like regulated utility giants such as Fortis, Canadian Utilities, and Emera. So what's the end result here? It's that clean energy companies do provide access to growing capital and strong dividends in certain cases. So with that in mind, let's take a look at 3 stocks that we think investors should take a second look at. And the first of which being Canadian Solar. We are going a little bit off the board with Canadian Solar. Typically, we stick to talking about TSX listed companies, so companies that trade in Canada. Canadian Solar actually trades on the NASDAQ, so it trades south of the border. However, we'd figure it was worth giving its due since it is a Canadian company. Now, in general, renewable companies and solar companies have seen a considerable increase in share price over the past few months, but this hasn't always been the case. Prior to this surge, Canadian Solar had traded sideways for the better part of 5 years. However, we think that investors and analysts are finally starting to see the potential in this small cap Canadian company. Canadian Solar benefits from a low cost production and has a decent amount of projects planned for the future. In fact, in August, the company stated it would be constructing one of the largest rooftop solar projects ever built in Malaysia, and it'll span more than 26,000 square kilometers. One of the reasons why solar power wasn't attractive as an investment previously was because it took a lot of heat, and production costs were extremely high, and it wasn't looked like as a permanent solution for the dirtier forms of power. However, we wouldn't even need to capture 1/100% of the energy hitting the earth in a year to be able to scrap every other form of energy generation. As cost productions come down, it's becoming a more feasible clean energy generation method. Now, I mentioned this previously, Canadian Solar itself has been a very frustrating stock to own. If you look at its long-term chart, the company has really done nothing until recently. That being said, even with the company's current 40% run-up, Canadian Solar is still cheap. Canadian Solar is trading significantly lower than the industry averages. It is also the only renewable energy company that we're going to bring to your attention today that doesn't pay a dividend. Since a company doesn't pay a dividend and doesn't generate stable cash flows like many of the other in the industry, we consider Canadian Solar to be one of the higher risk companies that we're going to bring to your attention today. However, it's definitely worth another look. It's cheap, and the company seems to have a long runway ahead. Next up on our list, we are going to be talking about Northland Power. We go from one of the most highly volatile performing renewable energy stocks to one of the better performing and most consistent performing renewable stocks on the TSX index. Northland Power has been a very, very strong renewable stock to hold. Although the company has outperformed in a big way over the past number of years, one might not realize that the company has been in business for a very long time. It was established in 1987, and it operates nearly 2,500 megawatts of electricity. The company also has an additional 400 megawatts of capacity under construction, which would increase gross production by 16.5%. Northland has witnessed some incredible growth in terms of earnings over the past couple of years. It has a 3-year compound annual growth rate of 31% in terms of earnings. Northland has also managed to more than double revenue since 2015. The bulk of the company's renewable operations are located in eastern Canada, And the farthest company reaches out west are 2 facilities in Saskatchewan. Its Spy Hill facility has 86 megawatts worth of production, and its North Battleford facility has 260 megawatts of production. Both of these facilities generate power by burning natural gas, and full contracts are established until 2036 and 2033 respectively. In total, the company has 25 assets, 2 of which we've already talked about. It has 19 facilities in the province of Ontario. Quebec has 2 wind farms, and it also has wind assets in Netherlands and Germany. In 2019, the company closed on its acquisition of EBSA, a Colombian regulated utility company, for about $1.05 billion. EBSA serves approximately 500,000 customers. Its revenue is highly regulated and thus provides the company with reliable cash flows. In terms of performance, Northland Power has been one of the most reliable. It has posted earnings beat in 6 straight quarters, often posting beats in excess of 50%. Analysts are expecting the company to exit fiscal 2021 with top-line growth of 26%, and it is also expected to generate 30% top-line growth in 2021. The company's 2.3% yield is not a whole lot to get excited about. However, it is backed by reliable and stable cash flows. The company isn't a reliable dividend growth stock. It is instead focused on growing the company's production profile. That's why we think the company is still positioned to reward investors. After the past 5 years, investors have been treated to approximately 186% gains. We expect Northland Power to continue outperforming given analyst estimates for, as we mentioned, approximately 30% top line growth next year. Next on our list, in our opinion, what is probably one of the best renewable stocks to own in the country, and that is Brookfield Renewable Partners. Brookfield is one of the largest renewable energy companies in North America, and we consider it to be best in class. And we can look no further than the company's performance over the past year to see why we consider it one of the best. In 2020, the company delivered returns of 67% through the end of December. This far outpaced the index. It's also worth noting that in 2020, the company underwent some organizational changes. It spun off BEPC last August, and BEPC nearly doubled in price, seeing gains of 93%. Now, BEPC and BEP.UN are intended to be economically equivalent, but BEPC has been consistently trading at a 30% premium to BEP.UN's share price, likely because BEPC is more attractive to institutional and US investors. Which you will choose will be highly dependent on many factors, but it's primarily a tax decision. The important aspect to remember is that from the company's perspective, 1 share of BEPC does equal 1 share of BEP.UN. Brookfield is a household name, and Renewable Partners is one of the largest pure-play renewable energy companies in the world. It has operations in 27 markets in 17 countries. It has over 5,000 power generating facility with a total capacity of 19,400 megawatts. The company generates strong cash flow and has grown funds from operations by a compound annual growth rate of 10% over the past decade. Strong cash flows, which supports the company's 2.8% yield. Also worth noting that Brookfield is a Canadian dividend aristocrat. It's committed to raising a distribution by 5 to 9% on an annual basis and has a targeted payout ratio from funds from operations of 70%. It aims to grow FFO by 6 to 11% annually and 10% FFO per share through 2025. As a market leader in a fast-growing industry, Brookfield is a rare combination of growth and income. Over the next 5 years, the company has increased its targeted annual equity deployments to between $800 million and $1 billion to meet growing demand. Quite simply, we are impressed by the company's ability to grow its asset base and at the same time reward shareholders with a growing dividend. In our opinion, Brookfield is simply one of the best renewable companies to own, and it is worthy of investors' considerations. I understand it looks expensive. It usually always does in comparison to their peers, but there's a reason for that. It's simply best in class. That brings us to the end of our video. There are many other renewable companies on the TSX index, but today we decided to focus on 3 interesting options for investors. Canadian Solar, which as a reminder trades on the NASDAQ, Northland Power, and Brookfield Renewable. Personally, I also own TransAlta Renewables, and I'd be interested to hearing from you in the comments what other renewable companies you might be potentially looking at, and which of these 3 do you prefer? Let us know in the comments. And as always, please like our video and subscribe to our channel for more great Canadian content. Till next time.